Hi, this is Peter St. Ange. Every week I grab key numbers torn from the headlines to make sense of what just happened, why it matters, and what comes next. No jargon, no mainstream spin, no agenda beyond maximum liberty and prosperity. New episodes drop every Friday morning at 7:30 Eastern on the dot on my completely free Substack at profsatange.com. Let's get started. 30%. That's how cheap New York Mayor Comrade Mamdani says the new city-run grocery stores will be. In order to stop the entire state of New Jersey driving over the bridge to get 30% off groceries, he also announced these stores will be checking ID to make sure you are a real New Yorker. Of course, we all know requiring ID is very racist and no married woman will be able to buy groceries, which seems cruel. So the problem with Mamdani's cheap eats is groceries as an industry sport about 2% profit margins, as in they make 2 cents on the dollar. So if you're selling 30% below, then a couple of interesting things happen. First, the taxpayer is losing at least 28 cents on the dollar, which quickly adds up to millions. And that's assuming that city-run groceries can operate with the same efficiency as a real grown-up grocery store like Aldi or Walmart. Second, if shoppers are getting 30% off, they're not going to regular grocery stores, meaning regular grocery stores will lose masses of customers, driving the marginal ones out of business. Then third, taxpayers get sick of losing tens or hundreds of billions and push to reduce the subsidies. Without subsidies and locked into those 30% discounts, the only way for these stores to survive is cut back on quality. So instead of a giant money hole, you get a slightly smaller money hole full of rotting food. This is exactly what's happened in other blue cities that have tried the city groceries thing, like Chicago or St. Louis, where the stores ended up with no customers because the food was rotten, so the city eventually shut them down with tens of millions of losses per store. When the smoke clears, you get a couple years of cheap bananas, an exodus of real grocery stores, and now New Yorkers have to take 2 trains and a bus to get a roast that is not rotten. Next up, 1.5%. That was headline GDP for the quarter that just ended. Now, 1.5 is pretty disappointing, only slightly higher than population growth. But the kicker is the Federal Reserve thinks that it's going to rebound fast. They're pegging current GDP growth, so-called GDP now, at a roaring 5%, which is better than 90% of quarters going back to the year 2000. Still, the media loves bad numbers when Trump is president, so they're hyping the 1.5. So why was growth so weak? Consumption, which is 2/3 of GDP, is actually doing great, growing about 3.2%. Final demand is even stronger, fortified by AI-related investments. What dragged it down was one-offs. An import surge ahead of new Trump tariffs hitting 60 countries. That surge knocked 1.5 points off GDP, so without that it would have been 3, which is strong, along with an accounting quirk involving how government counts sales of the Strategic Petroleum Reserve. Now, consumption was especially comforting since consumption was nearly flat the previous quarter, so growth accelerated 7 times despite the war, while investment is now growing so fast it's accounting for more than half of GDP growth. That matters because investment, unlike consumption, makes you richer in the future. It compounds. Boil it down, and growth for the year is on track for maybe 2.5%, which is solid but not spectacular. And it'll get a lot better if the war winds down and the Fed can get back to rate cuts, which are worth roughly 1 million jobs per percent of cut. If you own gold, and many of you do, you already understand how it protects your wealth from the insanity coming out of Washington, the inflation, the recessions, the wars. But with monetary metals, there's a way to actually earn a yield of up to 4% on your gold paid in more ounces of gold. You retain ownership of real allocated physical gold with no storage costs while your ounces grow every month outside the banking system. If you're serious about protecting your future and building your legacy, head to monetarymetals.com/Peter to get started. Now back to the show. Next up, 60,000. That's how many migrants flooded in to Spain's North African enclave of Ceuta in a single day, and then went on a rampage through the city, sacking stores and breaking into people's houses to squat, all while Spanish police and military stood and watched. What sparked it was Spain's Supreme Court deciding that you can't deport migrants who swim into the country. They have to defeat a formal barrier, or else they can stick around and claim asylum, which takes years. Migrants interpreted this as an open door, which turned out to be true as Spanish security forces stood back and watched the flood of overwhelmingly male military-age migrants who nearly outnumbered the 80,000 residents of the city, half of whom are Moroccan to begin with. Now, beyond Spain's Supreme Court being cute, the big draw was Spain's socialist government declaring amnesty earlier this year for up to 1 million illegal immigrants, which, given population, that's equivalent to 8 million amnestied in U.S. population terms. That still leaves the question how 60,000 people organized in a single day. At the moment, it appears that left-wing NGOs coordinated the surge. Remember, they're paid to feed, house, and massage migrants, probably with help from UN agencies that have been laser-focused not on getting rid of poverty, but on flooding the West with third-world migrants, all with an assist from the country of Morocco that surrounds Ceuta, which appears to have waved in the migrants presumably as pressure, since Morocco claims the entire city, which has been Spanish since 1580. Spain's only hope at this point is a change of government. In fact, the Conservatives did win the last election, but they couldn't form a government because Spain's regional parties refused to work with the populists, so the open border socialists took over. Spain does have an election upcoming by August next year where voters can decide if they're sick of the migrant invasions and amnesties. But in the meantime, other EU countries are already threatening to expel Spain from the EU's open border regime, the Schengen Agreement, saying if Spain cannot control its frontiers, then they will have to control theirs. This is not the last migrant invasion for Europe, especially with hostile neighbors encouraging them and billions-funded NGOs making it happen. So as bad as third world migration is in Europe, it's about to get a lot worse. And the fallout could, dare we dream, include literally breaking up the European Union. Next up, 163. That's how far the Japanese yen fell against the dollar before Japan lit $37 billion trying and failing to defend the yen, at which point the U.S. Treasury jumped in to help bail out the yen for the first time in 15 years. So I've been talking about Japan's problems in the regular videos. The core issue is Japan's economy is stagnant thanks to overregulation and institutionalized bailouts of large companies that hog up the manpower and capital that should be going to startups and new dynamic companies. It's been going on for 30 years now, and it requires extremely low interest rates, cheap loans, to work. In fact, for years on end, Japan had interest rates of roughly 0%, meaning those large companies were effectively getting paid to borrow money. The problem at the moment is after Bidenflation, the Fed hiked interest rates at the fastest pace since the 70s, which opened up a huge gulf between U.S. rates and Japanese rates. That meant you could borrow in Japan at 1% in yen, sell the yen for dollars, and use it to buy U.S. treasuries paying 5%, so free money. But of course, it involved selling enormous quantities of yen, which made the yen crash from 105 per dollar just 5 years ago to 163 today. In fact, the decline has been so extreme that according to cost of living calculator Numbeo, the cost of living in Tokyo is now just 10% higher than Mexico City. You'd have to go back to Argentina a century ago to find a country that has fallen so far so fast. The only way to stop it is for Japan to hike interest rates close to U.S. levels, but that would crash the zombie companies who cannot survive paying for loans, along with the banks and pensions where government bonds make up most of their assets. We got a taste of this in 2023 when Fed hikes blew a hole in our banks, including Silicon Valley, Signature Citizens, and First Republic. They were bailed out by the Fed and Treasury, but in Japan's case, the magnitude is much bigger, with roughly 2.5 times more government debt floating around in banks and pensions. The Japanese government is now painted into a corner where it cannot keep rates low because the yen will continue collapsing, which drives up inflation for households who vote, but it cannot hike because that destroys Japan Inc., including jobs and pensions, which will put even the Japanese in streets with torches. So the last man standing is always the U.S. Treasury bailing out America's ally in Asia to prevent the yen falling so hard that Japanese imports flood into the U.S., and to prevent a Japanese banking crisis that will cause them to sell the $1.1 trillion of U.S. Treasuries they're holding. Treasury markets driving up interest rates and borrowing costs in the U.S. economy and to U.S. government that's already spending over $1 trillion in interest. Would be spending a lot more if Japanese sales drove up interest rates. Even with American help, Japan is fighting a losing battle. Its best hope is to keep it a slow decline instead of a fast one. Even with American help, Japan is fighting a losing battle. Its best hope is to keep it a slow decline instead of a fast one. Prediction market Kalshi is currently pegging odds Japan hikes rates at 55% in the next meeting, with presumably more to come, meaning Japan is, in fact, choosing the yen and will let the economy hang. A word from our sponsor. No amount of time spent learning about macroeconomics or politics can save you from the fact that our money is broken. You can protect yourself by taking full control and holding Bitcoin in 100% self-custody. Now, there's a learning curve, but it's not rocket science, and you'll be in expert hands with my friends at The Bitcoin Way. They'll guide you through the process step by step, from setting up your hardware wallet to running your own node one-on-one and at your pace. Download your free self-custody guide from The Bitcoin Way by scanning the QR code or clicking the link below. The time to become sovereign over your wealth is now. Stocks and even gold are all over the place. If you're ready to diversify, Abundant Minds makes Bitcoin mining simple, transparent, and human. You can deduct every penny thanks to Trump's big beautiful bill. It's a 401k for Bitcoin mining. Founded by husband and wife team Bo and Christine Marie Turner after losing $500,000 to broken promises in the mining industry, Abundant Minds was built to protect investors. You own the machines. They make it turnkey with hosting at their facilities in Oregon. Pricing is clear with one flat monthly fee and no surprises, and they guarantee uptime so you can keep earning day in and day out. If you want easy diversification without pressure, learn more at abundantminds.com/Peter to get some of your first Bitcoin mined for free as a gift to my audience. Now back to the show. Next up, 3 times that is how much middle-class taxes would rise if America adopts the Scandinavian model of socialism, so beloved by the left. More interesting, if we go Scandinavian, taxes on the rich would fall by half, because the secret to Scandinavian socialism is that they do not tax rich people, they just tax everybody else. This comes from a new OECD report estimating the percent of GDP paid in tax for the top 1%, 10%, everybody else. According to the OECD, in the U.S., the top 1% pay 6% of GDP in taxes, while the bottom 80% of Americans pay just 9%, only slightly more. In Scandinavia, the top 1% pay 3% of GDP, so half, but the bottom 80% pay 26% of GDP in taxes. That's 9 times more. Note, Scandinavia also has sales tax, VAT, of 25%, which, of course, everybody pays unless they flee the country. Now, this is all fun because Scandinavia is held up as the poster child of a successful socialist system, when in reality, Scandinavia taxes nearly half of middle class and even blue collars, while giving the rich a free pass. Beyond tax, it's worth noting Scandinavia is in many ways much less socialist than the U.S. Take Sweden, where there is no minimum wage. You have universal school choice. You can take government money with you to private schools. There's no estate, inheritance, or gift tax. Social Security is partially private. Meanwhile, in the U.S., the federal government owns nearly 1/3 of the entire country. In the state of Nevada, it's a Soviet-level 90%. We have centrally planned domestic shipping, the so-called Jones Act. We have a near-government monopoly of postal and long-distance trains. We have thousands of price control boards on everything from milk to booze. In many states, it's illegal to sell food below cost. We have rent control in our biggest cities, and of course, medicine, where we have every socialized healthcare system in the world layered on top of each other. So Medicare is Canada, VA is Britain, Obamacare is Germany. In short, Scandinavian economies are arguably more free than the U.S., and in the one socialist area, taxes, they actually do not tax the rich. Instead, they confiscate half of what everybody else makes. Not sure how many middle-class and working-class Americans want their income taxes tripled so the DSA can run grocery stores. Next up, 20%. That is what percent of men support the Democrat Party, according to a new Quinnipiac poll, showing an absolute collapse in male support for Democrats. That's down from 45% support when Obama took office. So what's driving it? Part is a collapse in general support for Democrats, now that the mainstream media can no longer sugarcoat their abandonment of blue collars and minorities that used to be the Democrat base in favor of transgenders, NGOs, and Big Pharma. In fact, the poll itself found even self-declared Democrats feel the party is selling them out. The other part is the Democrat Party has openly turned on men, blaming men for every problem that besets the nation. This drove working-class white men to Trump. In fact, that's what handed him his victory in 2016. In the last election, 24, Hispanic and black men have started to shift, so now a majority of Hispanic men are Republican. Meanwhile, Democrats push anti-male policies from DEI that explicitly discriminates against men, to identity politics and speech restrictions, to globalism and open borders that are gutting blue-collar American men of all races. Put it together, and Democrats are losing their own brand of fighting for the little guy, and especially blue-collars, traded for the vanguard of the revolution representing graduate students and transgender NGOs. Now, there are Democrats who recognize what's happening, but if anything, the party is going further to the left. With the new Democrat Socialist gauntlet, every candidate has to run to win the nomination. So most likely what's next is the Democrat Party keeps slouching into oblivion until they lose an election so spectacularly that the few remaining sane leaders in the Democrat Party purge the radicals who want to abolish police and open the borders, so that the party can start to return to its JFK and FDR roots where it fought for regular people, not for freaks and corporations. Last, that's going to be a long process with mainstream media doing damage control, gaslighting the millions of voters who still vote Democrat out of muscle memory. So I suspect these dismal approval numbers of the party will continue to get worse. Those are all this week's numbers. Tune in next Friday for a fresh crop or to get it directly in your inbox with a free sign up at profsainage.com. Okay, we'll be watching. See you next time.